How's it going, guys? Welcome back to Taxes Made Simple. I'm your host, Karlton Dennis. In today's video, we are going to break down depreciation. I'm doing iPad training today because it has been requested by many of you for me to jump back on the iPad to teach you tax strategy information in an easy and layman's formats. I understand that we are already 5 and 6 months through the year already, which means you're already being taxed. But most importantly, I need you to know one of the biggest tax deductions that you have at your disposal. And that tax deduction is depreciation. There are certain investors who are leveraging depreciation. There are certain business owners who are leveraging depreciation. And there are certain W-2 employees who will never get to leverage depreciation. I'm here to educate you on how you can leverage depreciation for your 2022 taxes to save money. Let's get started. All right, guys, I'm excited to talk about depreciation because I'm a big real estate tax strategist. Why do I focus on real estate? Because I have a lot of business owners that get tired of paying for tax deductions. I have business owners that get on the phone with me that have told me they don't want to buy a car that weighs over 6,000 pounds. They tell me, Karlton, I am not locking up money into a solo 401k anymore. I'm not putting any more money into a SEP account that I can't touch until I'm 59 and a half. And I'm over being told to maximize all these retirement accounts that you guys have over there, okay? So what do when I have a taxpayer that doesn't want to really focus on spending more money as a business owner and buying cars, trucks, and more supplies? Or a business owner that doesn't want to lock up money into retirement accounts until they're 59 and a half, even though they understand retirement's important. They want to sit on more cash and have access to that cash, whether it's for additional investing, vacations, personal items, you name it. They want to be profitable and show profit just without paying as much taxes on it. This is when we start to look at depreciation. And depreciation is a very, very powerful tax write-off. Part of the reason depreciation is a powerful tax write-off is because depreciation is considered a phantom expense. That's right. I'm not trying to get spooky on you, but a phantom expense means that you are buying something that is giving you a tax benefit even though you didn't have to pay for the whole thing. What does that mean? Well, there's one way in which I can show you how depreciation is being leveraged. And I first want to start off with rental real estate. Let's jump into the iPad. So if I have a rental property here that I purchased, the government is going to allow for me to write off the building. The building has value just as the land has value. But the only downside is that the government does not give me a tax write-off for land. They only give me a tax write-off for building. Well, you might be a taxpayer that has only put a 5% or a 10% or a 20% down payment to get into your rental property, but you're able to write off 100% of the building's value. Why is this allowed by the government? Why does the government allow for you to get a loan from a bank and use that money to buy a rental property, but then give you a write-off for the entire investment, not just the money that you put up on the deal? The reason why the government does this is because when you go into rental real estate, you have decided to become a partner with the government. You're now playing into the government's entire system that they created with the banks, which is the mortgage system and the lending system. And when you're leveraging these two products that the government had a part in, you now get to benefit just as the government gets to benefit from collecting tax dollars. Your benefit comes in the form of depreciation, and depreciation is taken on the entire building's purchase amount. Now, we all know that when you drive an automobile off the lot, that when you drive it off the lot, as soon as you leave the lot, the car goes down in value. Why? Because when you buy a vehicle and you put miles on a vehicle and you breathe inside a car and decide to leave it outside in the rain, the sleet, the snow, you are now having an asset that has the ability to wear down and tear down and eventually possibly become obsolete, right? We now know that there are cars that have batteries in them that can go for long periods of time off just electricity without ever needing gasoline, right? Which means that eventually cars are going to change every 5 or so years. And the government realizes that after 5 years, typically a car is obsolete and you may need a new one. They considered it used up. And just like a car is used up in 5 years, an investment property for real estate is used up over a period of time. For residential real estate, this is 27.5 years. For commercial real estate, this is 39 years. Now, if I'm a taxpayer that is a business owner, I might need a car. And if I go and get a car that's over 6,000 pounds, the government tells me that I can write off 100% of this vehicle's purchase price all in 1 year. Which means that if I do the exact same thing that this taxpayer did buying real estate by leveraging only a 5%, 10%, or 20% down payment, I can write off 100% of a vehicle's purchase price over 1 year as opposed to 5 years. Okay? Now, you might be wondering, does this benefit also happen for real estate? There is some benefits that you can get from real estate. Just like being a business owner gives you the ability to write off a car that weighs over 6,000 pounds all in 1 year, the government gives you a benefit to buying rental real estate that will allow for you to write off the building's purchase amount and some of the building's assets all in 1 year. This strategy of being able to write off a building's purchase amount is called a cost segregation study. A cost segregation study allows for you to get all of the components inside of a property, segregate those components, and write them off in a quicker amount of time. I want you to follow me here for a moment, because as I explain depreciation, some people will stick on this subject with me to understand how the wealthy are using this to build wealth. And some people are going to look at this and think, oh man, he's going a little complex there. I should probably turn this off and go somewhere else. You will be the taxpayer that will never understand how to truly build wealth because you've decided to walk away from this information. For those who are stepping into the light right now, I commend you. Come a little bit closer. Let's continue this discussion. I have some props. Some of these props are a bathtub. I have a countertop. I have a refrigerator. And you know what? I even brought a stove in here because your boy Karlton loves to cook, and I'm cooking on this channel today. And the reason why I brought all these props in here is because I wanted to show you the assets that make up an investment property. When you make a down payment on a house and you're putting 5% down or 10% down or 20% down, you're not spending money to buy the entire bathtub, the entire kitchen and refrigerator, appliances, the electrical, the HVAC, the toilets. You're putting a down payment to buy the whole thing, and you're letting the banks cover the rest. That is called leverage. But your ability to write off the toilets, the countertops, the ovens, and the bathtubs is called depreciation. And unfortunately, you're only able to write off all of these components over the course of 27.5 years. The reason why you're able to write off these components over 27.5 years is because the government believes that you should take straight line depreciation. When you buy an asset as big as an investment property, the government believes that you're going to write off this entire thing over the course of time. Because when you think about it, you're going to be receiving rental income when you decide to rent out a property, right? Which means you're probably going to rent out that property over a long period of time, right? So rather than trying to write off everything that you have inside this house, such as all the appliances that we just talked about in 1 year, the government thinks, well, you're probably going to need those write-offs over long periods of time since you're going to be collecting rental income over long periods of time. So by default with a D, you're defaulted with your CPA, with your tax returns, you're defaulted into taking the straight line depreciation method. It's the basic method that pops up on the tax software when you file your tax returns. Now, Karlton, Is this the only way in which I can depreciate my rental property? The answer is no. Why? Because the government realizes there are certain taxpayers who are not going to wait 27 and a half years to write off all the different components in their property. So the government has created different depreciation methods. The different depreciations there are is called sum of the digits. This is another depreciation method that uses math to be able to accelerate depreciation. Another depreciation method is called double declining method. Double declining method is when you're taking double the amount of depreciation in the first year. And that is pretty awesome. We leverage the double declining method all the time in our office. Another method is called bonus depreciation. Bonus depreciation is when you're taking qualified improvement property. So if you made repairs to the property, or if you have assets that have been purchased after 1987 in your property, then you can choose to write off components inside of your property all in 1 year. Hold on a second, Karlton. This reminds me of the same scenario that you were talking about, where I can leverage Code Section 179 and write off a vehicle that weighs over 6,000 pounds all in 1 year. That's correct. The government has created ways for real estate investors to write off all of these components inside of their property in quicker than 1 year. And the way in which you perform a strategy to write off components in your property quicker than 27 and a half years, which is the straight line depreciation method, is by doing a cost segregation study. A cost segregation study will allow for an engineer and a tax professional to perform an analysis on the investment property that you're renting out. We understand that you're not wanting to wait 27 years to take all of this write-off on your tax returns. Matter of fact, real estate's supposed to put you at a loss on paper. Wouldn't you want to be at a paper loss every single year with real estate so you never pay any taxes on any of the rental income you have? More importantly, maybe you can use the losses that have been generated from all of this depreciation to offset other forms of income, such as 1099, W-2, stock, cryptocurrency. Maybe that's something that you're interested in. The only way we're going to be able to do that is by having enough losses on the tax return. The only way to take control of having enough losses on the tax return is by accelerating depreciation. The only way to accelerate depreciation with an investment property is by doing a cost segregation study. If you're looking to do a cost segregation study, you're going to have to get a quote from an engineer and a tax professional and know how much does it cost to perform the study on the property and how much are you going to save in taxes before you perform this. Because as soon as you front load your depreciation, you can't get brand new depreciation all over again with the same property. You're going to have to sell and possibly do a 1031 exchange. So the way for you to know if it makes sense for you to do a cost segregation study is to run the numbers. Let's talk about the cost segregation study. If I'm somebody that's interested in doing a cost segregation study, someone's going to have to segregate out all of the components. That means the appliances, that means the flooring, that means the roof, that means the driveway, that means the electrical. Someone has to segregate all of the components that make up my building. So that way there's dollars attached to all of these components. Once you're taking all of these components, you can choose to leverage just a cost segregation study, which is allowing for you to reallocate these components to write them off in a quicker amount of time, or you can leverage bonus depreciation. And now you're writing off some of these components all in 1 year. What I like to do is when I'm working with a taxpayer is I like to run the numbers of what a cost segregation study looks like first. After I run the numbers of a cost segregation study, then I'll run the numbers of a cost segregation plus double declining method. Once I run a cost segregation plus double declining method, then I'll run a cost segregation plus bonus depreciation. Bonus depreciation is me saying, okay, after I've reallocated all of these assets into its particular buckets, I'm choosing now to write off these components, the toilet, the appliances, the nuts, the bolts and screws of the property, all in 1 year. The difference between doing a cost segregation study alone without bonus depreciation is all you're doing with the cost segregation study is you're reallocating the components of the appliances, the roof, the flooring into its particular buckets. 5, 7, 10, 15, and then we get to determine what's left over in the 27.5 year. That's it. These buckets right here are the buckets the government has created. Let's go over it. I have the IRS website pulled open right now, and if you want to know what is the link, I'll place the link below so you guys can have the publication here. So what items are 5-year items? Appliances are 5-year items. So that means stoves and countertops, as well as refrigerators. Those are all gonna go into 5-year. What is 7-year property? 7-year property is office furniture, equipment, desk files. So anything that's desk files, office equipment is gonna come into 7-year property. 10-year property is really for an alternative depreciation system for equipment. So we have sometimes commercial investors who will have 10-year property. 15-year property is for roads, fences, driveways, as well as roofs. So now we know what 15-year property. And 27.5-year property, this is for residential real property. So this is the structure. This is the actual building's structure, the structural components, such as like the water pipes and like the venting. This is the actual structure of the property. These structural components remain in the 27.5-year bucket. Everything else, when doing a cost segregation study plus leveraging bonus depreciation, can all be written off in 1 year, okay? When you're writing off 50 to 70% of your building's value in 1 year, you're creating a huge tax loss on the tax return. I love tax losses because I like being able to help my clients get tax losses while also still earning cash flow from their tenants. And then I use the losses from this rental business to offset other forms of income. I'll use the losses to offset W-2, I'll use it to offset 1099, I'll use it to offset rental income if there's any other forms of rental income, I'll use it to offset crypto and stock income. Because depending on what I'm doing, I might categorize my real estate investor as a real estate professional, or I might instruct them on leveraging a short-term rental business so we can turn these passive losses into non-passive losses to offset our non-passive forms of income. Guys, I know that some of the information I teach on my channel can be very simple, and some of the information I teach on my channel can be very advanced. It's up to you to decide which videos that you want to watch. I'm giving you all of the information as somebody would have given me if I were in your shoes, the information I need to actually make wealth. This is the information around depreciation you have to understand. You have to understand the cost segregation study. You have to understand what straight line method is. You have to understand what bonus depreciation is, and you have to be smart enough to know when to pull the trigger on these strategies. These aren't things you really do alone. You're talking about big money here. You're talking about making financial decisions that will have ripple effects for generations because you're altering depreciation. So we take a proactive approach by doing tax planning with each of our clients to put up a form that shows you exactly how much you're gonna save, exactly how much you would owe if you were to do this strategy or if you were not to do the strategy. If you're somebody that's looking to get more education, I have a free case study below where I show you how to leverage real estate to avoid 90% of your other forms of income tax. If you're interested in that case study, click on the link below. To all others, you're more than welcome to join me on the next video. If you're somebody that's looking for more information, I also have my tax-free living bundle below that's on sale. Feel free to click the link below, and I look forward to having you on the next video. Cheers.